My name is John Needham. I will be your host for today. And David, thank you. You're a mind reader, and you saved me and the rest of the guests today from having to hear about whether we had good audio or not. But thanks for that, mate. And what have we got? Oh, is that right? Thank you. They've got a problem not getting a reminder from GoTo. Thank you, Lockie. I'll make a note of that and attend it. Right. So, what a wonderful time to be alive. Even better, what a wonderful time to be a futures trader. I mean, this is the best trading I can remember since 2009. The excitement level is intense, isn't it? You've got silver, one futures contract at $100,000 plus. You've got gold, which at its high tonight, or today I should say, was at 98,000 per one contract. I mean, it's just, the ranges are astonishing and the excitement levels are immense. And what flows from it all, I guess, is going to be even more interesting. And we'll deal with all that as we get there. So we've got all our wonderful usual supporters here today. Glad to have you with us, of course, folks. Let's see, we've got lots of them. We've got, Vicky's with us. Hello, Vicky, again. Thank you for being with us. Toddy from Southern California, Sean from Adelaide, Rolf from Melbourne. Good to have you with us, Rolf. Peter Mack, who's not a day trader. On Norbert up in the seriously cold country up in the north of Canada. Good for you, mate. Mark L, of course, a great stalwart. No party without Mark. You're always wonderful. Justin's with us, of course. And you folks will owe a debt of gratitude to Mark and Justin. They're the guys who feature mainly on our 4 feature videos on the homepage, telling you what discoveries they made while they were learning how to trade Danielcode time signals. John, good to have you with us. George, welcome back. Florian's with us. Hello, Florian, good to have you with us. Lockie, of course, many Davids, many Dale, that's the new one. Good to have you with us, my friend. Brendan, grand to have you with us. Peter, many Peters. Michaels, Zolly, thank you, Zolly. Nice to have you with us. Welcome. Welcome, everyone, in fact. So, what a day, what a thing that's happening with these markets. I mean, this is just magic stuff, isn't it? And I've said it's history in the making. Of course it is. Markets measure objective truth. Currencies and their real and psychological impacts can be seen and measured either in currency futures or in Forex. They do very much the same thing. They're a different mechanism internally, but they do exactly the same thing. All currencies, of course, are linked to other markets, which is why Forex and currency futures are expressed in pairs. So you'll have the US dollar and the Australian dollar. In the currency futures, it's just called Aussie dollar. It implies that the US dollar's on the other side of it. The coordinated yen-US dollar intervention, which we're going to talk about a little bit more today, benefits both Japan and the USA. All mercantile currencies and countries that have mercantile currencies, they're happy being weaker because a weaker currency makes your exports cheaper in the other currencies, and at the same time it makes your imports more expensive in the other currencies. So it's good for people with export income, businesses with export income, and of course it also helps a bit with your terms of trade because it's more attractive to export than it is to import, and it's really like makes the cost of imports that bit more expensive. We're going to talk about that at some length, and of course the standout story has got to be gold and silver. And this was a very interesting article written by a chap called David Kotok of Cumberland Advisors, calls the Shanghai Gold Hoard. And what he's talking about is the growth of essentially a new market based in China, where gold is stored in physical storage, certified to be there, etc., be the right percentage of gold, and they're issuing gold warrants. And those warrants represent direct claims on physical metal rather than paper exposure, which is what you get through the futures market. And this latest leg higher in gold has coincided with a surge in these warrants. The broader shift reflects US policy pushing participants away from Western infrastructure and towards Shanghai, where gold exposure sidesteps the futures market and tokenized claims. And also, of course, Western exchange and geopolitical scrutiny about money laundering, etc., etc. His motive, this is an article from Zero Hedge, says, note, it all starts going vertical when tariffs on China broaden and harden across industrial and tech-heavy categories. That's from the market ear. And this is the chart that they published with it. And as you can see this acceleration kicking in when the China tariffs have hardened up. And from there on, it's pretty much moving in lockstep. And it's an extraordinary thing. And of course, no one physical entity like the Shanghai Hoard, as he's called it, can control markets. But at the margin, a new buyer that hasn't been in the market before or has not been able to create its buying strength is hugely important, because if one assumes that the markets are generally in balance, then a new buy at the margin is huge. And that's what you're seeing here. And what I've said here in the previous slide was this is the third step. The first, the markets are always anxious, like everyone, they're anxious to find out what is making markets move. And the first story was, for a while, it was buying by central banks. The next story was, oh, there's now competition for gold between central banks. And this is the third story. And this one makes a whole lot more sense, that the Shanghai gold warrants are having such a huge effect by becoming a new marginal buyer with tremendous purchasing power. So that's part of the answer to what's happening with gold today. And here's a bit more information on them. They're a claim on the metal outside the Western system. You have to remember that the vast majority of international finance is controlled by what's called the SWIFT system. And the SWIFT system essentially is controlled by the USA. So their ability to interfere in other countries' business is immense through the SWIFT system. And they have used it as part of their boycotts and other. They're not. The United States is not unhappy to flex its muscles when it wants to. But this is a new system of gold, buying and selling gold through a China-centric system, and very attractive, of course, to countries in the Middle East and Asia. Because they can deal in this product without being exposed to the SWIFT system and all of the liabilities that go with that. So at a basic level, a gold warrant is a legal claim on specific physical gold. That gold is already stored in approved vaults in China. So think about that. This has been planned a long time. It's being done at a very professional basis. And of course, what flows from that is that the vaults have to keep buying as warrants are created. And that's that constant bid that we've seen in gold for a while now, and silver, of course, because gold and silver are so highly correlated that they're almost alternates to each other from a trading point of view, not from a physical point of view. And that warrant can be held, transferred, or pledged without moving the metal. So instead of trading paper gold, that's futures, ETF, swaps, you're holding a direct title to physical bullion sitting in a Chinese vault. And that is very, very attractive to a lot of buyers. And that's one of the reasons that we're seeing this sensational blow off top in gold, its last leg up, which we triggered off with a flip me buy signal. We're sitting at 76,000 at the close today, but it was 98,000 at the high of today's bar. Extreme measures, extraordinary, extraordinary historic moves, and I would say basic moves, because what would be even more interesting is how the market's going to establish a floor for this particular commodity, gold, and how the development of the Shanghai gold hoard progresses. So much to see there. This is COMEX silver. We had a same with it. We had a flip me buy signal to start off this big rally, which closed today at $100,000 plus, 100,700 excuse me, dollars at today's close, and of course much more at the high, which was today's high was up near the 12,126 mark. This is natural gas, which I've added in just to show you what we've been doing this week. We had a buy signal in this market, which was filled on a gap, and you may not have got into this trade, but it gave us a very nice $7,400 trade straight up. Remember, with all these Danielcode charts that I show you with money on them, we're always talking about per one contract, and particularly when we get into Forex a little bit later this morning, or this evening, I should say. Morning for me, evening for you folks overseas, most of you. You'll see how important this is showing us to be. We're also long crude oil, which got excited last night and put in a very, very large bar. And it was another flip me buy. Most of you should be aware, but we spent most of last year showing you flip me and teaching you how it worked and why it works so well. And it's a very potent tool into your trading repertoire. And in fact, it just goes to show that technique in many cases is just as important as signals. All of the Danielcode signals, I should say, are designed to come early and excuse me, and of course that's part of the way I designed them, because signals that come later are totally useless. These signals all have a trigger built into them. When we post these signals under our TO3, TO3 Plus or 6S trading systems, they tell you exactly the number the market's got to go to have your order filled. In other words, once we reach a state that we are happy that the markets are ripe for a turn, that they're showing all the relevant indicators, we don't just jump in and buy or sell that market. That would be hubris, and hubris gets your head chopped off in trading. What we do is we say, we believe that the market is now ripe for a turn, and if it is, excuse me. Oh dear, the dreaded hay fever. Do excuse me, folks. And if the market is ripe for a turn, we wanted to show us that it agrees with our analysis. So as part of all Danielcode trade signals, you'll have an entry point, and you'll have the initial stop loss, which becomes your failure point. And flip me is an extension of that. If that failure point is reached, then the market is telling you you're wrong, and if you're wrong, you need to do something about it. And what you normally need to do about it is flip your trade from a buy to a sell, or sell to a buy. It's really simple when I explain it like that, but it's also very, very powerful, as you can see here. So there was our trade in crude oil, and here we are. This is our Teach Yourself to Trade video program, folks, which has been running for a couple of years now. It's been immensely successful. And on our front page, I show you 4 videos that you can watch for yourself. One's from Mark L, the other, and 2 of the others are from Justin with us today, and an enormous amount of work that these guys have done, and they're happy to share that with you. You really should watch these videos, and if you haven't, you're going to get a shock, and particularly the level of understanding of markets that Mark L and Justin bring to you through their videos. I find it extraordinary and very, very beneficial, of course. So that's what we call our Teach Yourself to Trade. It's a short video series. Each of the videos is probably about 90 minutes. I sent with the invitation the syllabus for the basic various lessons in it, and you can buy these video series and you can do it, learn about it all in your own time, in your own house, or wherever you like, and you've got them there as reference in the future if you ever need to brush up your thinking a bit. This is something about what the TTT video series is about, and as I say, you can read more about it in the attachment I sent you with the invitation at this webinar, or on the website if that suits you better. There's the link at the bottom, the Danielcode.com display, PHP (nav equals TYT. And you're welcome to go and have a look at all of that. So, apart from the obvious excitement in gold and silver, and what else is happening is the currency wars of 2026. Well, they haven't started yet, but I suggest they're going to. And this is a post from Zero Hedge on Monday of this week. And what it's telling you is that essentially the US Fed has coordinated with the Bank of Japan to intervene in the currency markets by selling a big bunch of US dollar contracts, pushing the US dollar down against the yen. Now, the yen has had a troubled history of weakness for years and years and years, and that comes from the backstory of the various leaders of the Bank of Japan over years believing that MMT, or magic money theory, was effective. And with that thought in mind, what they've done is they've been able to hold their interest rate on Japanese bonds at an artificially low level, making them more attractive. But that, of course, is only part of the equation, because if your currency is going downhill rapidly, then it is not attractive to external foreign investors, because what they're making on the return is getting eroded very quickly by the movements in currency. So Japanese yen prices, or yield rather, and the levels of the Japanese yen against its major trading partners go together, and it has to be viewed that way. And this this move to strengthen the yen against, in particular, the US dollar, means everything else has to follow. That's the result of something the US has not done since the Fukushima nuclear power disaster in 2011. And what they've done is explained here too. They have asked the various big players in the market for their advice as to liquidity at certain price levels. And that in the past has been used as a preamble to intervention by the Fed in currency markets. And it was certainly taken that way in this instance. And it created an instant reaction. And here we are, the Fed reached out to potential trading counterparties and collected called rate checks, accounting to people familiar with the market. That is, inquiries about the pricing available if it intervened in currency markets by trading dollars and yen. So it carries out financial transactions on the Treasury's behalf. And as the article tells you, this has been a signal in the past that authorities are concerned about how a particular currency is trading, and it can precede a direct intervention. So very, very unusual, very infrequent, as the previous slide told you, not used as a tool since 2011. And that's exactly what the Fed did in this intervention. Caught the market napping, and we had a very big, excuse me, daily move. Now, on the larger time frame, it's not really material. You can see this is our 59-day chart, which is a very, very long-term chart. And what's happened is we've had support at that blue line of 95,725. Ridiculous, do excuse me. 95,725, and that has been support for a long time. These are 59-day bars, so this is like a Danielcode quarterly chart, if you wish. So it broke that support there, which has been holding, as I say, for many months, and it just slipped down to the next level, which was the red line at 95,320. And that's where it held. So on a large-scale discussion of this action by the Fed, it hasn't been material, but you'll see on the daily charts, it's been pretty significant. The whole point of these interventions are that, to some extent, threatening the intervention can work, particularly when the US Fed's involved with its almost unlimited firepower. But it's not going to work unless it's followed up with something material from the Bank of Japan. So this has been sitting around now for 4 or 5 days, and nothing has come out of the Bank of Japan apart from some jawboning about their new president, who's got a very large, expensive agenda to fill, which is what's driving a bit of the angst in the yen pairs crosses. So you can see nothing significant in the big movement. But if you look at the daily movement, they have been significant. This is dollar yen futures, forex I should say, daily charts, and you can see this got triggered for us on a flip me sell signal here. We had a TO3 buy signal. As I've explained to you, all Danielcode trade signals have an entry point, and they have a initial stop loss, which becomes the failure point. And if that trade is elected, as this one was, and then fails within a certain period of time, that's a flip me signal, which is really telling you you're wrong. And if you're wrong, you need to do something about it. What you need to do in this case was to get short. And you can see some pretty massive bars here, $3,000 per one contract. And these forex contracts are quite small, so $3,000 on a few bars is a big move, a substantial move, and it's starting to threaten some important lows that are not far away to the downside. So we may see an extension of this move perhaps next week, which would be interesting. Here's the other side of it, and this is what's going to set up the currency wars, is that all the foreign pairs, particularly Australia, Canada, Great Britain, GBP, and Euro, they've had their currencies made much stronger. And that for trading countries is not what they want. It's not what the trading companies want. They are like, as is Trump, they're very mercantilist people. They want their currencies as low as possible within reason, because as I say, it makes your exports appear cheaper in the alternate currency, the other side of the forex pair or currency futures pair, and it makes gives you the other benefit that it makes imports more expensive, which helps with the balance of trade figures. So countries like Australia, Canada in particular, the agricultural countries, they're feeling this straight away. They're feeling this whack, and agriculture hasn't been too strong lately, as I talked about at our last session, when we talked a bit about the troubles with the soybean farmers and the wheat farmers in the US, because China hasn't bought their usual amount of product. This is the second year. So this is horrible for you to have to listen to, folks. I do apologize. Should end soon. So here's the euro trade against the US dollar. Exactly the same thing, and almost the same dollar amount, that it's just making the euro more expensive against the dollar. Now, these sort of moves can happen, have happened, will continue to happen, but this has the added, what's the word, the added credibility, I guess, that we now know that this was a combined US and Bank of Japan intervention. You'll see the same thing, of course. All these USD pairs are highly correlated. They're so highly correlated that a signal in any one of them can be executed in any other. And this is one of those ones where we had to buy signals in the other USD pairs, and it could have been executed in the British pound if you wish. Notice how, despite these different currencies having sort of similar amounts of value but totally different tick values, they all seem to come out about the same level, and $3,600 in a matter of a few days is a very significant move in currency markets. This is the Kiwi, the New Zealand dollar. It's a particularly weak currency. It's a small country, largely agricultural based. And you can see it's been a big move for the Kiwi, which is very highly correlated with the Australian dollar, because about 80%, I believe, from memory, of its trade is done with Australia, which is its larger cousin, if you like. So these moves are all correlated, and it's going to be interesting to see if the Bank of Japan can follow up with any incentives and initiatives to keep strengthening their dollar. Historically, the chances of that happening successfully are very poor. The Japanese yen has been notoriously weak on international markets for years and years, and it's unlikely to be anything significant to change that, other than the fact that you have the new president in there, who's a lady whose name escapes me for the moment, and the plan, the initiatives that she's bringing to the electorate involve some very aggressive spending. And it's that planning for the next Japanese budget that's caused a lot of the more recent worry about the yen. Okay, here's the here's the loonie, the Canadian dollar against the US dollar. This pair is called the loonie, and the loonie is Canada's national bird. It's like New Zealand, it's called the kiwi because the kiwi is a flightless bird in New Zealand. Very beautiful. So anyway, this is the loonie, same old thing. This was a little bit more direct. This came straight off a TO3 cell signal, which found some legs. It was a muted just rolling over the first couple of days from the high, but then it certainly found some legs and kept going. So it's part of this whole mix of currencies. Same thing, New Zealand terms of trade against the US it affected negatively because the US dollar is now weaker, relatively speaking, against the Canadian dollar, and that makes Canada's exports to the US more expensive, and the imports from the US to Canada are, get this right, exports appear cheaper, imports appear more expensive. There we are. So they're the two rights about that. I wanted to take you now, folks, a little bit to what's happening in equity markets. And this is quite simply a daily chart of the S&P. And I have a unique theory about what's happening in the US equities market and the S&P in particular. And you'll see that I've got a bar, an arrow pointing to an outside bar. There's bars that are in grey are what we call outside bars because they have a high high and a lower low. This, in fact, is not a true outside bar. It's the market being fooled by technology because the technology just confirms today's high against the previous day's high. But if you look closely, you can see that from the previous day's high, there's quite a long green line running upwards. And that's there on Danielcode charts to tell you there's a gap. This market gapped down and left that gap. And the true high of, this was Tuesday's bar last week, go back a day from that, Monday, which I think was a holiday, was it not? But nevertheless, it's got a bar there signifying that it traded, which it did up until the closing hours as set by the exchange. But this particular bar, this large grey bar pointing down and really accelerating the down move from the previous 4 or 5 days, was reported as being the second biggest day of retail selling in the last 6 months. Think about that, because I like the trade. I was short into it, and as you can see, it closed right on its Danielcode blue line at 68.29. Nothing wrong with any of that, except for the statement that it was the second biggest day of retail buying in 6 months. Well, retail buyers don't generally buy fast-moving charts. They do buy dips all the time. That's a big function of theirs. But they don't, historically, they don't get involved in trying to stop a big, strong downward move with plenty of momentum in it. So what could have caused this to be reported as the second biggest day of retail buying? Who are and what are the entities that could be classified as retail buying? And of course, I'm very cynical about this. I believe deeply that the PPT, the Plunge Protection Team, as it's called, a Treasury offshoot, is very, very active in financial markets. There's massive pressure on government at the moment to keep equity markets high. That's one of Trump's main talking points for the midterm elections coming up later this year. To me, the fact that this was reported as the second largest day of retail selling just didn't make any sense. Yes, retail sellers buy the dips, they're the leaders at that, but no, they don't step into what they say, don't be trying to catch a falling knife. And retail buyers are pretty astute about that. So I think this shows you that there is a substantial amount of PPT management in this market. Note that I didn't say intervention, which it is, but more management, because you should see what happens after that. From that huge bar there, look at the next bar that goes up. It stops. The high of that bar, I've got a number 1 against it, is exactly at the Danielcode black line of 69.46. This is the futures chart. And we publish these charts for members. You can see it in our website all the time. The next day, the market closed exactly on that same red line. That's target recognition very, very specifically. What happened the next day? Little inside bar closed exactly on that same red line. So here you've got a high and 2 closes all at that same level. Then it gets punked up, and it was a very strange day the next day. It gapped down in the European and Asian session and opened, as you can see, in the US session way down, and then bang, up she went in a rush. Where did it go to? The high is exactly at the blue line, one of 4 of them there that you can see. Next day, and where did it close? It closed, run off a few ticks, it closed almost exactly on the red line at 68.78. Next day, opened a bit below the previous day's close, ran up into the next blue line. That stopped it. What was the next day? Same sort of thing. Opened, ran up to the blue line, reversed, and went down to the red line, which was sitting there at 69.78. And to do today's big sell-off, which was largely called by reports, annual reports from Microsoft, that they had some very, sorry, very fantastic sales figures and profit margins about their business in China. But the market didn't believe them. It promptly said, hooey, don't believe that. And Microsoft was down dramatically early in trading today, which has attributed to general weakness across the board in other places. But something that sounded on appearance to be so random, of course, wasn't random at all, because look where the low came. We had the Danielcode black line, which I've talked to you about many times, at 68.97, and there it was. There's the low, bang, almost exactly on that black line. And where did it go from there? Rallied up, went through most levels of the previous levels of resistance, and managed to close at that Danielcode red line, less a handful of ticks, not much, which had been measured the high with arrow number 4, as you can see. So either the PPT is using the Danielcode charts for trading, or maybe the PPT is the Danielcode. I'll leave it to you to think about it, but it's certainly very, very precise, very, very managed, and while we are talking about the S&P, you should be thinking about the NASDAQ. Now, remember that the Mag 7, the Magnificent 7, as they call the super big tech stocks, NVIDIA, Meta, Microsoft, etc. Those 7 stocks represent about 40% of the S&P entirely. Out of 500 stocks, 7, or the parts of them, represent 40% of the S&P. The massive growth in the S&P is hugely applicable to what's been happening in the NASDAQ and those stock prices on the Magnificent 7 in particular. And periodically over the last 14 months or so, we've seen the market turn to the Russell, which is the small caps index, and run that up and boost it often when the S&P and NASDAQ are showing weakness. And of course, that's raised the inevitable question, is strength in the Russell significant enough on its own to help support the S&P? And the answer is no, not even close. And that's just a furphy. And we have such a huge level of commentators and commentary. Yes, Dale, I'll get to you in a moment, mate. It's such a huge level of commentary that it can get very confusing. The point I'm making is it doesn't have to be confusing, because Danielcode is dominating all of these markets, always does. I was talking to Frank DB a couple of weeks ago, and as I told you, he is proposing that he stops his coverage in the fourth seal of crude oil and replaces it with US T-bond, which he thinks has got a big move, big long-term move coming up shortly. So we'll look forward to that. That should be happening very shortly, and we certainly do see the PPT active in bonds a lot. But this thing is just so precise since that big bar, that big outside bar, Tuesday, January the 20th, which I flagged for you. All of these moves are just according to the book of Daniel. High, low, close, again and again and again. It's quite extraordinary. And as I say, it points to the PPT is either using Danielcode technology or perhaps it is the Danielcode. We'll find out, but that's certainly a big effort that's going on. For you, Dale, what software is required to trade the Danielcode? We have had for many, many years, Dale, an association with Trade Navigator. That association is not now as good as it was over many years. So you can use Trade Navigator software, or in reality, you can use any other software. And in the TTT video series, there's a lesson on exactly how to set up the Danielcode studies, some of which are in Trade Navigator, but if you're not going to use Trade Navigator, you can create those same studies very, very well, very effectively in any other software package that interests you. Okay, so excuse my going sideways there, guys. Let's have a look at this S&P thing again. Have a look at this. Here's a daily chart, same thing. This is January the 22nd. I want you to highlight. Look at that low, exactly on the red line. Look at the next low, that inside day, exactly on the red line. Amazing stuff, isn't it? And of course, that high on January 22nd came in exactly at the blue line. These markets are just ranging between the Danielcode numbers, and it's telling us something. But it's wonderful trading, and as I've been telling you for a few months now, the daily ranges in equities, and of course gold, which is ludicrous, have got so much bigger that day trading, short-term trading, is now very profitable and very appealing, I should say, as well. And I've been day trading now for a couple of months or so, and it's very beneficial. I do. If you had any interest in day trading, I suggest you rekindle that interest, because it's really a wonderful, wonderful time to be doing any sort of trading, including that intraday. Here we are. So this is just another chart showing you the same issue I'm trying to explain of the Danielcode target precision on intraday charts. This was a big bar down today. It looked exciting based on that weakness in Microsoft early. You got your sell signal there, and then it got re-elected long on the outside bar, this big grey bar here, but then the flip me kicked in and you got short at the low of the previous bar. look where it goes to. It runs straight down onto its Danielcode blue lines, and the low, today's low, came with 3 tick variance from the Danielcode number. Not 3 points, 3 ticks. Like, woof, $36 per one contract from the low. Look what happened with the bar after that. Just perfect today, 29th. That was the one. 3 ticks variance from 68, 97, 50. Wonderful stuff, isn't it? Then look at the high after that. That market recovered very, very strongly and made its high for the day just 2 ticks away from one of the upper blue lines at 69, 98, 50. Extraordinary stuff, isn't it? I mean, I've been doing this Danielcode trading, Danielcode numbers, creating and publishing the members charts for you and the signals. I've been doing that for 20, 25, 26 years now. And I've been trading for 5 or 6 years longer than that. And I've seen this stuff all the time. And I can tell you, nobody is more surprised and more excited about the Danielcode, the way it just finds these numbers. Extraordinary. And earlier today, I was fishing around trying to find you a short-term chart, which I think was maybe Tuesday. And it's quite extraordinary. I couldn't find it for you. I'll try and highlight it for you at the next webinar. But what the market did is it had made its high, it was wandering down lower, it had reached significant support, and it was starting to rally 3 or 4 or 5 bars on a 30-minute chart. When all of a sudden it took off, it dived, it just went straight down and hit the Danielcode black line, and was there for 2 seconds and turned around and bounced all the way back up. Now, how could that have happened? Well, obviously the market had to find the Danielcode number. That's a pattern of Danielcode. It happens all the time. Why does it happen? Well, Frank DB said, the Danielcode will end the trade. This Danielcode is so incredibly powerful that it's staggering, even to me. As I say, I've been living with this beast now for well over 30 years, and no one is more thrilled, amazed, and excited to see what this market is doing, and it's doing it on all time frames. You've seen, those of you who have been at other webinars, you've seen our 6-day chart, our long-term charts, how incredibly accurate they are. And now we're seeing a bit today. I'm trying to show you how incredibly accurate the short-term trading is as well. Variance in a matter of ticks. Now, remember, this market is a whole lot bigger than it was when I started inventing this stuff, when the market was less than 3,000. Now it's at 7,000. And 0.1% is actually, if you think about it, 7 points. That's 1/10 of 1%. That's what we say is the allowable market variance. But in fact, it works at half that level. It's now working at 0.05%. And it's just so incredibly accurate. You see this 2 or 3, 4 handful of ticks variance from Danielcode forecast numbers happens all the time in all markets. They're all exactly the same. All markets trade identically on Danielcode ratios and numbers. So just a quick snapshot to show you. This is the S&P, which is by no means the most volatile market at the moment. Those, of course, those prizes belong with the precious metals. But today, simple sort of a day, exactly you saw where it went to. There was the low, there's the second day, the intraday high. $6,500 daily range. I mean, that's worth trading, folks. I've been doing it. I've been day trading. For those of you who are not aware, I explained that I was very much against day trading for many years, and that's largely a function of our daily trading just being so incredibly outstanding. But lately, I've been teaching my son to trade, And as part of that, he wanted to know about short-term trading. So I had to brush out the cobwebs and go back to those many, many years I spent as a very short-term trader and teach it to him. And I've been day trading equities and gold and natural gas, of course, since then. And the results are phenomenal. I really do urge you to think about it. If you have any of that propensity to be a short-term trader, you'll love it. So, folks, I hope you've been interested in what I've been talking to you about today. I do apologize for the dreaded hay fever. It's just absolutely stupid. It arrives without warning and makes a complete mess of itself. But that's what we want to talk to you about today, those twin thoughts to think about. The probable expansion of the negative US dollar trend, which is more to boost the Japanese yen. How are they going to keep that little boost that it's had? How are they going to lock that in? We need something in the next few days from the Bank of Japan to give buyers confidence that there's going to be some forward-going strength in the yen, the dollar-yen pair. The probabilities are it won't work. That's had many, well, at least a number of attempts at intervening to support the Japanese yen. This is the Bank of Japan I'm talking about, and it hasn't been successful. So the probabilities are this time won't be successful either. But it's interesting, and you should be well aware of what's happening and what's driving the rally in yen, because that's such an important currency. You know, it's the favored currency for the long-term carry trades, and it has all sorts of implications for that effect. So do think about that. Do think about what the golden horde in China have been doing, how exciting gold and silver trading is and has been. And of course, remember, the next part that comes, the correction, is always the most exciting part. And of course, as futures traders and forex traders, we are always with the trend. So when gold corrects as it must, and silver corrects as it must, you can be sure they'll be doing so on a Danielcode trade signal. Okay, folks, if you haven't already, please go to the Danielcode website and have a free trial. If you haven't already, just click on the free trial button and follow the prompts. If you have any problems at all, please contact Terry at support@thedanielcode.com. He will be happy to assist you. Yes, the Danielcode website has a long memory. If you've already had a free trial, it won't want to give you another trial. It's a bit mean like that. But if you contact Terry, he will enable you to have a free trial so you can see everything we do at the website and see what parts of what we do is of most interest to you. So this is our standard disclaimer that tells you do not start trading forex or futures with real money until you are completely confident that you are a safe and profitable trader. And to become a safe and profitable trader, easiest and best way is take one of the many Danielcode courses, and it will teach you how to trade safely and profitably. The reality is that 90% of new traders lose their bank in the first 90 days of trading. That's the industry standard. I think that's being completely generous. My observation is that most new traders will lose their starting bank in the first 30 days of trading, if not less. So do take the time to make sure you've learned to trade and that you are competent before you risk real money. And once you have become a safe and competent trader, the world is your oyster. It's at your feet. Help yourself. Endless amounts of money and lots of enjoyment as well. So that's it for today, folks. You take care. Have a lovely weekend. And I will see you all in another fortnight. For Americans who don't use the term fortnight, it is a British expression meaning 2 weeks or 14 nights. is 2 weeks. And at the next webinar, if there's anything in particular you'd like me to talk about, do drop me an email, jneedham@thedanielcode.com, and I will be happy to get something prepared for you that may be of particular interest to you. For now, that's the end for me at this webinar. Thank you very much for being with me. I apologize again for the dreaded hay fever. I could tell you I've been to every specialist known. I've never had hay fever in my life till we came back from New Zealand, which was 2013. And I've had farms, properties, horse stables, horse stud, cattle, sheep, you name it. Cattle yards, sheep yards, covered in dust, covered in everything else. Never even had a hint of hay fever. Completely alien. And now for some reason, I've got this ridiculous aspects of hay fever, which do embarrass me, and I'm sure they're terribly annoying to you. So thank you for bearing with me, folks, and I'll look forward to seeing you at our next webinar. Bye-bye for now.